Okay, hi everybody. So I'm an economist at King's College London, and actually I don't want to talk about climate risk. I want to talk about a new financial risk, which happens to be climate related. Okay, and that's a really important reframing. In other words, so much of ESG and sustainability and all that stuff we've all heard is exhausting because frankly most of it wasn't worth the paper it was written on or the air that it occupied, because most of it was made up and greenwashed. Okay, finally, at last, and it's partly thanks to all the rhetoric, that it's beginning to enter the financial mainstream, the real system. And I think insurance is the mechanism. And that's the story I just want to tell you in about the next 13 or 14 minutes. Okay? So we're hearing a lot. The Paris Agreement probably is what most of us think of when we think of sustainability. The truth is, it was a very technocratic answer to a very complicated problem. It was essentially, you have to do this. It was rule-based. It was introduced in parallel to business, completely separate, really. Any benefits to business were hardly discussed, and if they were theoretical. Okay, so business naturally kind of went along with it until the rubber started meeting the road, and hang on a minute, you want me to employ people, incur costs, and there's no upside. And naturally, that created space for political opportunists, but also business opportunists who are just interested in the very short term. Okay, what's interesting is, it's what I call the Paris consensus. Okay, it's breaking down, no question. And what's interesting is that it's breaking down at the very time when we need it most, because climate risks are increasing more than ever. And that's what I want to show you. So I was just saying in another room now, but a couple of weeks ago, I was at an insurance conference, and I promise you, probably the top 2 or 3 topics continually came back to this issue. The insurers are miles ahead of us. They all have models, what they call location-based risk. They know, is this a particular area for flooding, or drought, or heat waves, or wildfires, whatever it may be. And they map their assets on there, their exposure, okay? And this is kind of what I want to talk to you about, because it's pretty imperative as business people. Okay, so the issue is, do we listen to the rhetoric or do we just follow the risks? Okay, what I want to introduce you to is this tool. It's free, you can look at it online. It's updated quarterly, and it's called the Actuaries Climate Index. It's from the American Academy of Actuaries. And this is data for the USA and Canada. There's versions in Australia, France, Spain, etc. And like any index, it's a basket of metrics. And in this case, the metrics are low and high temperature, drought, precipitation, extreme wind, and they've added sea level rise. Okay, so they're the 6 metrics. They took a benchmark period from 1960 to 1991, as you see there. And basically, the y-axis is the standard deviations relative to that benchmark. Okay, and you can see from basically the benchmark period, 1990, it's pretty much gone off the charts ever since. Now, I like it for 2 reasons. One, actuaries know what they're talking about. Their job is to calculate the probability of massive payouts for their employers, the insurers. And secondly, it doesn't decide in causality, right? Maybe Trump is right. Maybe this is the biggest con job on the world. It doesn't say that. It just says, we don't know why these things are happening. Just observe that they are. Who knows why? It's a mystery. But we don't need to know why for the rest of what I want to say. Okay? These weather risks and sea level rise are introducing 2 types of risk, which some of you may be familiar with, what's called physical risks, and they are self-explanatory: drought, wildfires, heat waves, etc. And then what they call transition risks, which are typically, to our business models, our ability to keep generating cash in the same way, supply chains, all that stuff. Okay? So they're the 2 types of risks, and I'm going to touch on both. I want to focus, though, really on physical risks and how it's playing out in our lives. And you'll see this index in the news. I'm just going to go back a couple of years. This is drought in Spain. 20% of Spain is already desert. 74% of the country is vulnerable to becoming desert. If you have assets in Spain, they are going to be affected by this. Your insurance premiums are going to go through the roof. Okay? Water is a massive issue too. If you look at the heat waves, we had them again this year. Add Turkey to the list this year. Wildfires accompanied them. Okay? I'll talk more about what that means for food in a moment. Flooding, acute flooding. So you'll see on these charts, some of them are acute and some of them are chronic, just like a medical condition. Chronic is kind of persistent. I've got a bad back persistently. And acute is I was struck down. Okay? This is flooding in Mai in Kenya. Here in UAE last year, they had big flooding, very surprising flash flooding. One of the issues with really hard ground when you become desertified is that the water's got nowhere to go when it does rain. And so it just literally washes off the top and you get these terrible flash floods. There was a lot of economic damage here, and I'll come back to that a little later on. I mean, the government dealt with it very well. They have the resources to deal with it well, but a lot of other places don't. Sea level rise, this is from Suzu City in Japan. The Metropolitan Administration in Japan have just issued the world's first climate resilience bond last week to raise funds, to raise the sea defenses, move bridges, move power lines. They're not doing that for fun. They're doing it because they've got 14.5 million people living there, and they have to protect them. Otherwise, the taxes are going to go through the roof. Okay? China, we've had David on and off through the last couple of days, and Yang, chronic smog. Many, many Chinese cities. That's why they're actually doing a lot in this space. Saudi, again, up the road here in last year, terrible heat waves, really extreme. Several thousand people died at Mecca. Go back to Spain, you've got this intense flooding in the drought that I talked about last year, just before Christmas, if you remember, it was really bad in Valencia. Brisbane earlier this year. I'm going all over the world with this. Okay? Florida, famously, extreme winds, just at the same time, interestingly, so that's on the East Coast, at the very same time on the West Coast, LA was burning. Okay, we all remember that. Now what's interesting, and it's the same in Dubai, by the way, the top figure is the total economic losses estimated as a result of the LA wildfires, right? The small figure is the insurance costs of that. In other words, there's a gap of 210 billion, which was uninsured. Okay, Dubai, they estimate about 8 billion losses from last year's floods, of which 3.4 billion were insured. That's another gap. Okay? This matters because if you think about it, physical risks, like I've been describing, droughts, put huge stresses on buildings, floods is a problem, subsidence, 40% of London is prone to subsidence by 2040. Okay? Tokyo, New York has a local law 97. For any of you who got hotels over there, it's about building performance. It's about building a fund to move infrastructure in New York State and New York City. Okay? All these things matter because they affect your most important asset other than your people, which is your venues, your buildings. Okay? You are a hugely intensely physical asset, real estate heavy industry. Okay? And these risks, these new financial risks, are attacking that directly. And you can see that systemically, what this would do to the global economy, this adds up to about 378 trillion as a global asset class, which, just to give you some context, the world economy this year is probably going to be 115, 20 trillion, something like that. Okay? So it is by far the bedrock of the entire financial system. That is why, my friends in the insurance world, we're talking about not much else, frankly. And the smart banks, yes, they're withdrawing from various things, but privately, they're all really, really looking at this. It makes complete sense. Why would they take the risk? Okay? The second types of risk I mentioned are what we call transition risks. So these are less about physical assets and real estate and more about your business model. Can this model continue to generate cash into the future, which is the other side of what an investor needs to know? You were talking quite a lot about smart capital, which is looking for yield as well as the return at disposal of the asset. So transition risks, this is a very simple illustration. It's the price of olives following those heat waves I talked about in 2023, and you can see the crop failed, prices go up. We know that, supply and demand, it's very simple. Again, it's happened this year. It will be pretty short time, I think, before olive oil becomes a real luxury commodity, which is remarkable when you think about it. This insurance gap that I've been talking about, this is just data from the EU, but it gives you some sense of the scale of it. It's here in the Middle East, it's all over the world. It's huge in America as well. But the dark bits are essentially hugely vulnerable. You can see it's the gap, effectively, between assets that are insured and assets that are not insured. Now, the insurance business has two options. It's either withdrawing from markets, which is what it did, by the way, in California. Allstate and State Farm withdrew from the market because they couldn't charge the premiums they wanted to charge for various regulatory reasons, and it doesn't really matter why. They're now able to price climate risk into their premium, by the way, as a result. But they can't withdraw from markets all over the world. Australia, huge chunks of Australia are now uninsurable. Okay? So again, what you're finding is that the insurers are going, we simply can't underwrite this. So they're going to have to switch. They can't just turn off all their markets. So what they're going to start doing is, what they were telling me, they're going to start rewarding people who help them mitigate the risk. So go back to LA as an example. If you rebuild a building of brick rather than wood, you have fire-resistant materials, you employ fire marshals, etc., they'll give you a discount on the premium. Okay? This is just a quick slide to show you that you need to think about time in a very different way when you're dealing in this space. You've got economic time, financial time, you've got bond time, is different capital market time, and you've got environmental time. And you need to think about which variety of time you're making decisions in. There's a performance benefit to this, both from a cost reduction and revenue increase, which is something we call the adaptation curve. And obviously it all comes together in what you all know and love, which is the discounted cash flow models. Think about it. If EBITDA is being affected and your property value is being undermined, it's hard to get investment. Okay? That's kind of all I want to say. We run this course at King's. I've designed it specially for this industry. Please come along. It's remote, essentially. It's for the world, and you're all welcome to come. And we're now having a link with EHL to make it operational at the asset level. Our course is designed for people like you, executives, people who understand the finances of this. So we get a lot of corporate treasurers, CFOs, those kind of people on it. That's it. That's all I wanted to say. Thank you.